Welcome to the Business Standard Banking Show. The universe of small finance banks form 1% of the total assets of the scheduled commercial banks in India. The Reserve Bank of India, in its recent financial stability report, observed that the high balance sheet growth of small finance banks from a very low base has raised some concern on the asset quality front. Also, RBI has said the SFB's restructured standard advances portfolio remains higher than the pre-pandemic level, though it is below the peak level of September 2021. To discuss the issues surrounding the SFBs and particularly of Suryoday Small Finance Bank, we have today Baskar Babu, MD and CEO, Suryoday Small Finance Bank. Welcome to the show, Mr. Babu.
Thank you much.
Sir, first let us focus on the SFB universe, some of the issues which are facing the SFBs. Then I will come to the bank in particular bit later. Do you think SFBs are going at a bit of fast pace and sometimes compromising on the underwriting standards?
I do not really think so, but however, we're all new to banking, just 5 years old across the universe, quite a bit of our learnings on the go. So all the growth that we do at this point of time has to also be balanced by adequate or more than adequate risk control measures. So to that extent, the regulator wanting us to rebalance the portfolio, moderating the growth meaningfully to make sure that you don't really cross the line in terms of where the growth creates more risk than is known to the bank itself. So to that extent, yes, but otherwise, I do not think that SFBs are growing at a pace compromising the underwriting standards. However, in the last 5 years, last 2.5 years, we have seen an unusual impact of a once in a lifetime of event probably is in terms of the COVID and impact. And the impact has been substantially larger on the low income households than probably on the other segments. So to that extent, the negative impact that we all felt, it was a little more. And the good news is that as the economy is recovering, this segment of ours is probably recovering a little more faster. And we are seeing an improvement across all parameters, including collection efficiency, including in terms of reduction in GNPA. And also many customers were not paid for many months together. Usually was presumed will turn only into a write-off. They're coming back as they're wanting to get back into the borrowing fold and want to kind of have good track record, which enables them to be financially meaningful.
RBI has also observed that the standard restructured portfolio of SFBs have remained higher than the pre-pandemic levels. Do you see a significant part of the portfolio turning non-performing going ahead?
It does on a temporary basis, yes, not significant, but close to 60 to 65% of the portfolio starts paying. When they start repaying after coming out of a moratorium, there is this possibility of them skipping an installment once in 2 months, once in 3 months, which from a time stamping point of view may convert itself into a non-performing asset. But will they really tend towards a write-off credit loss? The answer is no. So the customers, as they come out of a moratorium of 6 months and 1 year, the repayment while they start repaying the installments, that kind of the inability to repay every month on time after a gap ahead tends to kind of make probably 30 to 40% of the customers into the non-repayment. Some depending on institution to institution, but they may not necessarily turn into a credit loss, as these customers have had good track record and probably have gained quite a bit in terms of ability to pay. The timing will be of some essence.
But overall, do you think this year could be a normal year? Last 2 years, I know SFBs and MFIs have a lot of pressure because of COVID, but do you expect this year to become a normal one like the pre-COVID one overall?
I would summarize that it tend to be a very normal year. In Q1, sequentially every quarter should look better than the previous quarter, barring any other unknown impact really happening. But as things stand today, so every quarter sequentially looks to be kind of better, will kind of pan out to be better than the previous quarters. Okay. It will move towards normalcy as the year progresses.
Coming to Suryoday Small Finance Bank, the bank has recently released the Q1 business figures. Are you slowing down your business growth consciously and focusing more on collections and recoveries?
Usually Q1 is never substantially higher than Q4 across the financial services banking segment. So to the extent we're not slowing down on growth, but however we are very, very focused in terms of ensuring that the growth is not coming at the cost of robustness of the portfolio or collection efficiency. So there's equal amount of focus going on. There has been a 25 to 27% growth across all parameters on a year-on-year basis, which is what we have been targeting. Our intent itself, as guided earlier, is to have a good growth range between 20 to 25% across all parameters year on year.
What kind of loan growth projection you have for the current financial year?
So, as we guided earlier, targeted loan growth on a very stable basis would be between 20 to 25% across all parameters, both deposits as well as in terms of assets. So 20
to 25%.
That's right.
So you have kind of toned down your loan growth from what you have projected earlier?
No, by and large, we guided around same 25. So 20 to 25, we'll continue to maintain that. And this year will be a year where we'll clearly kind of invest substantially in terms of technology, in terms of risk management systems, and ensuring that your backed asset portfolio is substantially much better than we ended the last year with. So there will be equal focus in terms of collections, portfolio quality, substantially higher focus there. And given that the robustness has come back into the microfinance customer households and also the other segments that we operate, the focus also be in terms of balancing the portfolio. So to the extent we stay with earlier guidance between 20 to 20%.
Coming to the collection part, the collection efficiency, Suryoday has beefed up the collection team. There are, I think, quite a number of people specifically focusing on collection. Have you seen an encouraging trend in the first quarter so far as collection efficiency is concerned, and what kind of collection efficiency you're looking at for the entire year?
So we're looking at a collection efficiency growth of 2% every quarter. So we are at closer to 90% at this point of time. So our intent is to really kind of go beyond 95% towards the end of the third quarter. And
95%.
And the collection efficiency of the portfolio built after July 21, which is post COVID-2, is currently running at around close to 98.5 to 99%. We intend that will continue to be so, and as the portfolio gets substantially built out of the new portfolio, collection efficiency go up, and the old collection efficiency was at around 70 to 75%. And we have seen a good traction in terms of, because of the collection, specialized collection task force, which is focused in terms of customer who are not paid even for 6 months at a stretch. As we get in touch with the customer, we have seen quite a bit of around close to 30 to 35,000 customers coming back into the paying fold who have not paid for longer. So it has worked for two reasons. One, I think as the number of delinquent customers went up, the ability of the regular team to be in touch with them on a continuous basis, on more frequent basis, got diminished. So with the focus of the collection team, more than the collection team, it is a team which is focusing in terms of getting back in touch with the customer. We see lots of customers coming back in terms of the repayment. So that is what gives us the confidence to edge the collection efficiency by sequentially by 2% every quarter and close to 95% by end of Q3.
Suryoday's gross NPA was 11.8% as on March, and you had a target to bring it down by 8% to 8% by the first quarter. Given the trend in the first quarter, do you think you are on track to achieve the target?
We are yet to declare our results, so to the extent some of these numbers will not be able to kind of disclose. But however, what we guided 8% was towards the Q2, not in terms of where we were right. It was not the targeted one is to go to Q2 during the year and not at the end of the Q1. In Q1, what we guided was that we provide for closer to 40 to 50 crores of provisioning as is required. So which will be the residual provisioning for what we see as stressed assets, and a spillover of that will be in Q2. So we are kind of on target in terms of what you indicated as a number of less than 8% towards during the year, and well could happen within the middle of the year.
What is the longer term, medium term roadmap for gross NPAs? What is the level you are seeing, say 4 quarters or 5 quarters down the line?
I think the ideal one which we'll target, which we should kind of get into it, is around sub 3% to 4% in terms of GNPA and sub 1.5% in terms of NPA, considering the segments that we are operating in.
By when you want to achieve that?
Probably closer to the end of the year.
Last year, the provisions made by banks was about 400 crores. So this year, do you think provision could remain elevated, or provisions requirement could be much lesser?
So as we guided, I'll go by what guidance we have given. We guided that whatever provisioning that we required will be done in Q1 and a spillover in Q2 for the whole portfolio, and thereafter whatever provisioning would be required would be more towards in terms of a regular normal portfolio as a really build up. So it will not be as elevated as it was last year, as we also guided that the worst is probably over from in terms of whatever provisioning that we do. So it will not be as elevated or as higher as it was last year.
On the cost income ratio front, you were able to cut down the cost income ratio significantly to around 60% from 67% at the end of FY21. Where do you see the ratio going ahead by the end of the year?
We're always a bank with a cost to income of less than 50%. The target is to move towards that. It may not necessarily happen during this year, but clearly the trajectory will be in terms of taking it closer to sub 50%, probably few quarters away from now.
I mean, how do you see the rising interest rate scenario in terms of customers' ability to repay? Do you think the kind of interest rate increase that people in the market is talking could impact to some extent the ability to repay?
Usually, these have a direct impact on larger ticket loans taken for longer tenors, where even a small movement in interest rate increases the EMI by a couple of percentage points. Since we are in the low ticket, low tenor segment, one, we are not intending to pass on 0.5% or 70 basis points increase to our microfinance segment at all. We are retaining the same pricing at which we operated even 6 months back at this point of time. While we are also having an excess liquidity. So most of this liquidity, which is low earning at this point of time in treasury instruments, will get converted into earning assets. So to that extent, the impact of an incremental increase of 50 to 75 basis points in the cost of borrowing or cost of deposits will not have any impact on the P&L for this year.
Mr. Babu, thank you so much for speaking to Business Standard. It was a pleasure talking to you, sir.
Always, Manojit. Thank you very much. Good day.
Thank you, sir.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
I am the blue of the limitless sky. I am the inspiration that led success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.